balances, and in the trial balances, you find the assets, the liability accounts, the income, and the expenses accounts of the parent and the subsidiary. So we have now also given our the shareholders' equity accounts of both. So also we are given the information that there is no goodwill impairment loss for 20x5. Now we have the following requirements. Using cost model, number one, determine the following items for January 20x4. A. Consolidated retained earnings. B. Non-controlling interest. And C. Consolidated stockholders' equity. So for the requirement, first we begin with consolidated retained earnings. In requirement number one, letter A. Using the cost model in number one, we determine on January 1, 20x4, the retained earnings in the consolidated retained earnings portion. The consolidated retained earnings on January 1, 20x4 is the retained earnings balance of the parent P. So that's now given 360,000. That's the case that if you're asked to determine the consolidated retained earnings, it's that amount from the parent's records. So we now get 360,000. Now the second requirement is to determine in letter B, number one, letter B, determine the non-controlling interests. So with regards to the non-controlling interest, we may use an NCI, either partial or full. Okay, so we now begin with non-controlling interest, partial goodwill on January 1, 20x4. And non-controlling interest, you just write NCI. Non-controlling interest, partial goodwill on January 1, 20x4. So we now begin with common stock as company, 240,000. Retained earnings as company, 120,000. So we now get the shareholders' equity of S company, 360,000. Now all of these are for January 1, 20x4. So 240 add 120, you get 360, and you refer to the trial balances given as of December 31, 20, X4. You have these figures given. You also have data given on January 1, 20, X4. So the shareholders' equity of S company on January 1, 20x4 of 360,000, we now reflect adjustments for the fair value over or under valuation. We now reflect adjustments for the fair value over or under valuation of assets and liabilities on January 1, 20x4, the amount of 90,000. I'm going to explain 90,000 at the bottom. So we have 90,000 adjustments to reflect fair value over or under valuation of assets and liabilities, date of acquisition for 90,000. So 360,000 add 90,000, the total is 450,000. That is the fair value of shareholders' equity of S. 450,000 Then we multiply 20%. That's the non-controlling interest percentage. We get 90,000. That's the non-controlling interest partial. Non-controlling interest partial goodwill or proportionate interest. So non-controlling interest, partial goodwill of 90,000. Then we add the non-controlling interest on full goodwill. We add the non-controlling interest on full goodwill equal to 3,000. The total is 93,000. That's the non-controlling interest, full goodwill, or fair value basis. So 93,000, that's our non-controlling interest, full goodwill, or fair value basis. Okay. Now, where did we get the non-controlling interest on full goodwill of 3,000? 3,000 is the difference between 15,000 and 12,000. The difference between 15,000 and 12,000. So how did we get 15,000? Okay, let us explain how the non-controlling interest on full goodwill was arrived at. The amount of 3,000. I mentioned this is the difference between 15,000, your full goodwill, and 12,000. So you get the NCI on full goodwill of 3,000. Now, how did we get 15,000? We now compute for this the consideration transferred. The fair value of the consideration transferred is 372,000. Now, that's the consideration transferred by the parent. 372,000, then we add the fair value of the NCI of 93,000. That's given in the first paragraph of the problem. 372,000 add 93,000. The total is 465,000. Then we deduct the book value of the shareholders' equity of S. The book value is the sum of common stock, 240,000, and retained earnings of 120,000. So 240,000 plus 120,000, the total is 360,000. That's the book value of the shareholders' equity. 465,000 minus 360,000. The difference is 105,000. That is the allocated excess. The excess of cost over the book value of the net assets of S. So 105,000 is the excess of cost over book value. From 105,000, we are going to deduct the allocated excess over or under valuation of assets and liabilities. We deduct the allocated excess over or under valuation of assets and liabilities in the amount of 90,000. Where we got 90,000, I'm going to explain that again at the bottom. Okay? So, 105,000 minus 90,000, the difference is 15,000. That's the full goodwill. The excess of your cost over the fair value. So we have now 15,000. That's the amount considered as the NCI on full goodwill is the difference between 15,000 and 12,000. 12,000 is 80% of 15,000. So meaning the non-controlling interest here is 20% of 15,000. That's 3,000. So the non-controlling interest using the full goodwill fair value basis is 93,000. Okay, next. Let's explain where 90,000 was taken. That's your fair value over under valuation. So, you create three columns. You create three columns aside from a wider space on the left. So, the three columns is company book value, column 1. Second column is company fair value. And third column, over under valuation. So over inside the parentheses. Over inside the parentheses. And then under valuation. Now these are the three columns. Okay, we begin with inventory. Inventory, the book value is 24,000. Then the fair value is 30,000. The fair value is greater than the book value, so the 6,000 is under valuation. Meaning ang 24,000 is undervalued. Then we go to land, 48 against 55,200. So the undervaluation is 7,200. Okay? Then we go to equipment at net. The net amount of equipment under the book value column is 84,000. The difference between 180,000 cost and 96,000 accumulated depreciation. So the net amount of equipment at its book value is 84,000. We compare it with the fair value of 180,000. So the difference between the two is 96,000. That's your undervaluation again. Okay. Next, we go to buildings at net. The cost of the building, 360,000. Then its accumulated depreciation, 192,000. The book value is 168,000. We compare it with the fair value of 144,000. There is an overvaluation in the amount of 24,000. Overvaluation, 24,000. And finally, bonds payable being a liability. We have book value 120,000 and the fair value is 115,200, meaning there is an undervaluation. Take note, this is a liability, unlike the other accounts above, which are all assets. So here, 4,800 is the undervaluation. We consider the book value, no? For 120, while the fair value is 115,200. However, this is a liability. So it means an undervaluation. Now, if we get the total of the book value, the net, net is adding the credit, the additions, and then deduct 120,000. And for the fair value, we add the four items and deduct 115,200. So, The net book value is 204,000. The net fair value is 294,000. So the over or the under valuation is 90,000. 294 minus 204, that means 290. Now you try to analyze going downward. If you get 290 correct, inventory add 6,000, land add 7,200, equipment add 96,000, deduct buildings 24,000, and bonds payable add 4,800. So the net over under valuation is 90,000. In order to support the 90,000 that we have added above. Okay, continue. The buildings and equipment will be further analyzed for consolidation purposes. So the buildings and equipment will further be analyzed for consolidation purposes. Okay, so again, we create through three columns. Column 1, book value. Column 2, fair value. And column 3, increase, decrease. So decrease enclosed in parentheses. Okay, so book value, fair value, increase, decrease. We begin with equipment. Equipment book value 180,000 less accumulated depreciation. So it means that the net book value of the equipment is 84,000. 180,000 minus 96,000. The net book value of the equipment is 84,000. Okay, the fair value is 180,000, meaning the increase in value is 96,000. Again, this is an undervaluation. Now, we go to the buildings. The building, okay, column 1, book value, 360,000. Column 2, fair value, 144,000. So there is a decrease of 216,000. Or you may now get the book value of 168,000. So anyway, you can do two things. One is to deduct 192 from 360. You get the net book value of 168, just like for equipment. The fair value is 144. So that gives us the net decrease of 24,000. Or you compare 360 with 144, you get a net decrease of 216,000. And you deduct accumulated depreciation of 192,000. Now you still have the net book value of 24,000. Again, it is a decrease. Next, we go to the summary of depreciation and amortization adjustments as follows. Now, we have to create again five columns aside from a wider space at the left. So create 5 columns. A summary of depreciation and amortization adjustments is as follows. First line, adjustments to be amortized. Adjustments to be amortized or to be fully charged. We now begin with inventory. Over, under. So under applied inventory, since the fair value is 6,000 higher than the book value. So we have now under the over, under 6,000 and the life is 1 year. 1 year lang because the problem stated that the inventory was sold during the year and it is using the FIFO basis. So the life is 1 year. The annual amount is 6,000 for the adjustment. So you charge it against the current year, 2,000 x 4. Nothing goes to 1,000 x 5 because this inventory involved was already sold during 20 x 4. Then we go to subject to annual amortization or depreciation. Subject to annual amortization or depreciation. We have the equipment, 96,000, first column, under. Then life, 8 years, annual amount, 12,000. That's taken by dividing 96,000 by 8. So annual amount, 12,000. Current year, X4, 12,000. X5, 12,000. Okay? So 9, 6, 8, 12, 12, and 12. We go to buildings at net. There was a decrease in the value of the building, meaning a decrease by 24,000. So this is the adjustment. We are going to adjust the building accounts accumulated depreciation. So 24,000 negative, we are going to divide by 4. So the annual amount is 6,000 negative 420x4, 6,000 negative, and for x5, 6,000 negative. That will be up to 2,007. Since you are now recognizing 6,000 a year. And finally, we have the bonds payable. The bonds payable, 4,800. That was the undervaluation. Remember, this is liability and its nature is the reverse of an asset. 4,800 divided by 4, the annual amount is 1,200. And 20x4, 1,200. 20x5 is 1,200. We have to think about amortization of discount, which we use to debit discount on bonds payable, and bonds payable is a credit. So for the totals, for the annual amount, the total is 13,200. For the annual amount, the total is 13,200. Then for the current year, it's 13,200. For 20x5, it's 7,200. 7,200. That is for 20x5. So we are now through with the requirement number 1B. Number 1A, okay. Number 1B, okay. Now we go to requirement 1C. In requirement 1C, we have to compute for the consolidated shareholders' equity, assuming a partial proportionate goodwill or full or fair value basis. So, in partial or proportionate goodwill in letter C, we begin with consolidated shareholders' equity. Common stock at 10 par, 600,000. That is taken from the books of the parent. So, common stock at 10 par, 600,000. Retained earnings, 360,000. Sa kaipilang niha. So, we have the total of 960,000. That's the shareholders' equity of P. And we add the NCI computed in letter B above. So the NCI is 90,000. That NCI is the one with a partial goodwill, and with the NCI partial goodwill. So we add 90,000. The sum is 1,050,000. That's the consolidated shareholders' equity on January 1, 2024 for partial or proportionate goodwill. Now, the second is to compute for the consolidated shareholders' equity by using full goodwill or fair value goodwill. So we now have the consolidated shareholders' equity. We are now adding common stock of P, then its retained earnings. The total is 960,000. We add the NCI in letter B. We add the NCI for full goodwill. So the NCI for full goodwill is 93,000. So finally adding the parents' shareholders' equity of 960,000, we add the NCI in letter B of 93,000. We get the consolidated shareholders' equity on January 1, 2024 in the amount of 1,053,000. 1,053,000. So that gives you the consolidated shareholders' equity at the end of the year. Okay? Now we are done with requirement number 1. We still have 2, 3, 4, 5, and 6. So many requirements. Okay. Shall we continue now? Our Zoom will end by 4:50. So we can renew it once. Okay, now, what is the requirement of number 2? For number 2, we have to determine the following items for December 31, 20x4 and 20x5 in the consolidated financial statements. Okay? So we now begin with consolidated. So meaning, we are going to add cash. Cash. We add the balance of P and S. So that gives us cash of 322,800. Now, first, let's fill up the partial goodwill column. Partial goodwill column. Cash, 322,800. Adding that of P and S. Then accounts receivable, 150,000. Inventory, 210,000. We got adjustments, but one is to debit inventory and the other one, charging the inventory to cost of sales, is to credit inventory. So the adjustments now, debit, credit, the effect is 0. So again, inventory is 210,000. Then we have land for the total of 265,200. 265,200. That's for land. 265,200. Okay? Because there is an undervaluation of 7,000 200. Next, we are going to get the balance of equipment. Equipment, that of P is 240,000. That of S, 180,000. Then we deduct accumulated depreciation of 135,000 and 96,000. 135,000 and 96,000. 135,000 amo na ang accumulated depreciation in the books of P found in the trial balance. Okay. In the trial balance of P, given is accumulated depreciation 135. That of S is 96,000. Likewise, in your equipment account, we are adding 96,000. Why do we add 96,000? In our analysis in B, 96,000 represents an undervaluation. Reflected is the amount of an addition of 96,000. And also, we have treated 12,000 as an additional accumulated depreciation in the computations we had in letter B. We have the current year. We charge depreciation of 12,000. So that will also be credited to accumulated depreciation 12,000, which means that this will be deducted from equipment. So now you take note of the amounts in the equipment account. Since the format shows equipment at net. So in other words, we have to deduct the corresponding accumulated depreciation. So equipment at net, 240 plus 180 minus 135 minus 96 plus the other 96 minus 12. So the amount is 273,000. That's now under your partial goodwill column. 273,000 for your equipment at net. Okay, let's continue with the building account. The building accounts, okay. The building beginning balance upon acquisition. So the building has a balance of 720,000. So building 720,000 for the parent, and is the building has a balance of 540,000. Okay. So building 720 and 540. Since we are required to show this at net, so we have to deduct accumulated depreciation 405,000 and 288,000. 405,000 the accumulated depreciation of the building in the books of P, and 288,000 in the books of S. Okay? Then we deduct 216,000. 216,000, that is the overvaluation in the building account as shown in our analysis in letter B. You will notice that the building account had a decrease of 216,000. The 216,000, we are going to deduct from buildings and add the amount of 192,000 and 6,000. So I'll repeat, buildings 720 plus 540 minus 405 minus 288 minus 216 plus 192 and plus 6. In other words, you can find all this in your requirement number 1B. That will give you the balance of the building account equal to how much? How much is the balance of the building account under the partial goodwill? That gives 549,000. 549,000. So we have buildings at net 720, add 540 minus 405 minus 288 minus 216 plus 192 and plus 6. So the building now finally has a balance of 549,000. 549,000. Okay. Of course, the account investment in stocks was already eliminated in the working paper. Now, if we try to determine the total assets, the list does not include goodwill. But in computing total assets, we need to include goodwill. And the goodwill here that we have to include is 9,000. Goodwill of 9,000. How did we find 9,000? 9,000 being the partial goodwill, we deduct the impairment loss. Given the problem, there is an impairment loss of 3,750. We multiply that by 80%. The impairment loss that will go to the parents or the partial goodwill column, no? So the impairment loss is 3,750. We multiply that by 80%. We get 3,000. So 12,000 minus 3,000. Share of the parent in the impairment loss. The amount of goodwill to be shown in the books is 9,000. Again, 9,000 is the difference between 12,000, the allocated amount to goodwill, and we have 3,000, the impairment loss share of the company in. Okay, impairment loss. So we have now